Hi, everyone. This is the webinar you have all been waiting for. No pressure, Clem. We have been talking about this last round of, we're calling it our down payment recovery package from Congress. And hopefully this second round, for some of you, first round for others of PPP, will get you through the coming weeks. For once, I don't have to participate a lot in this webinar, so I'm very excited to just sit back and drink my coffee. But this is, I just want to say thank you to my friend Erin at the PA Bankers, who is one of my good friends, for reaching out to me when the mitigation order came down literally on December 10th and said, what can we do? And I said, we need help when the next federal bill comes through. And she came through and she got us Clem, who has put together an awesome PowerPoint and all of those questions that you have been asking me in the last 2 weeks. And I said, we're waiting for the regs. We should have a pretty good answer for all of those questions today. So we're going to ask you to stay muted. Post your questions in the chat box, and we will hopefully have some time at the end to go through them. I know some of you submitted questions ahead of time, which I have. And if they do get answered during the webinar, we probably will not revisit them and again, just to give everybody a chance to get new questions out there. But again, just want to thank the PA Bankers and Clem, who is one of their members from NexTier Bank, for doing this for us. And we're already at over 100 participants, so this is kind of a big deal. So with that, Clem, I'll turn it over to you, and we'll do questions at the end. And yes, this will be recorded. All right, I'm muting. It's all yours, Clem.
Well, thanks for that introduction, Melissa. Boy, that was a lot of pressure that you just put on me. So hopefully we can live up to that. Certainly there are a lot of questions that are out there on how this new program is going to work. The guidance just came out yesterday, so I was up late in the night kind of reading through things, seeing what other people's interpretations are. So we'll try to get the best answers for you right now. If we can't answer something, we will certainly try to follow up with you offline and get you the responses you need. So why don't we go ahead and jump right in? I guess I should state that the way I have the slides set up, it's really assuming that you were already through the first round of funding. So it doesn't talk about a lot of different things like how do you specifically calculate payroll costs. We certainly can entertain some of those questions. A lot of those detailed questions, unfortunately, I didn't get into all those details the last time. The gentleman that runs the program for us at the bank was going to join the call today, but he's homesick today, so he wasn't able to join. But we will again follow up on any questions that maybe we cannot answer today. So first few slides to go through, just kind of general knowledge of NexTier Bank. We'll just skip through those pretty quickly here, but I do want to make sure that everybody knows that I'm just a banker. I'm not an attorney. I'm not a tax accountant. Just read through the documentation last night, so we'll try to give you the best advice, but certainly rely upon your attorneys, your tax accountants for the best legal analysis there. A little presentation on me. You'll see my face enough on the webinar. You don't need to see that picture. A little information on NexTier Bank. We are centered mostly in Western PA, but we do a lot of lending out in Ohio. We actually have a location in Camp Hill, and what is not updated on this slide is that this past summer we added a new location up in Du Bois, PA as well. So that's all I'm going to say for NexTier Bank, and let's get to the program. I wanted to start off by showing what information is out there for us to digest. Most of the comments today are coming from these two documents. They were just released 2 days ago, so we have 82 pages for the first rule that was issued, and then 42 pages for the second rule. So a lot to read through, a lot to get through. The links are there for people to follow. The first rule is really set up to take all of the guidance that had already been issued under the original program, pull that together to have just kind of a single point of reference for everybody. It does add some of the new criteria that applies to both the first round loans and the second draw loans. So Just to clarify terminology here that I'll be using, I think the title of this webinar is PPP Round 3. As you remember, the first round came out early last year. Money was expended pretty quickly, so Congress refunded that. We were calling that Round 2. So with this is Round 3. But I'm going to try to get rid of that round language, because the way that these rules are set up now, it really talks about first draw and second draw. So first draw is everything that has happened in 2020. All the loans that have been made up to this point in time is referred to as the first draw loans. Those have been extended. We'll talk about how you can jump back into those rules, but Congress has made available what they're terming as the second draw loans as well, which most of the webinar will talk about. So first rule was set up to talk about things that affect both the first draw and second draw. And then the second rule, the 42-page document, deals solely with second draw applications and what terms and processes are pertinent to those. So a little cleanup work on the round 1, round 2 first draw loans. To me, especially from a banker standpoint, but certainly from a borrower standpoint, one of the biggest things here is the simplified forgiveness application. This is something that industries across the board have been begging Congress and SBA to correct really ever since the program came out. So what we now have is a simplified forgiveness application that's going to be issued in the coming days for all loans under $150,000. This application is supposed to be a one-page document. It will just have really these 4 items listed here. So you'll have to disclose the number of employees that were retained by using the funds. You'll have to disclose an estimated spend on the payroll costs, state what your total loan amount was, and then there'll be the borrower attestations that we've all kind of become familiar with on how the funds were used, and making sure that we were getting some feedback, but it just cleared up. So up to this point in time, any applications, you were required to submit detailed records on how you calculated your forgiveness amount, what you were qualified for, how those funds were expended. If your loan is $150,000 and you're using this new forgiveness application that will be released, you won't have to provide those records to the lender. Now, it's important that you still maintain those records. You need to make sure that you've calculated the amount correctly. These loans are subject to audits. We have been seeing audits on very small loans as well as large loans. So if your loan is selected for an audit, you would have to be able to submit those to the lender to get to the SBA to fulfill that audit requirement. They do have a time period. They're supposed to have this application within 24 days of the act being implemented. So that should be coming out next week, assuming everything is on track. Second big fix that I think people are excited about is the EIDL advance. I think a lot of people had taken EIDL loans as part of the original process. You could apply for the EIDL grant. I think unbeknownst to most people, the rules required that grant to be deducted from your PPP loan when you were seeking forgiveness. I think I'm correct on this. Every loan that we've received forgiveness application that has been processed through SBA, our experience is everything has been forgiven except for these EIDL loan amounts. So we had several come back that people still owed the $10,000 from the EIDL grant. That now has been fixed. That clause has been removed from the act. So that deduction will no longer happen on your PPP loans. If you have submitted a forgiveness application that's already been processed, already been approved by SBA as forgiven and paid off, but that grant amount remained. The SBA is working through that process. They will be remitting that deducted amount to the lender along with any interest that was owed. If you have paid off that loan, I know several of the customers, when that came back, is still being owed. They just went ahead and paid that amount off with us. Obviously, the lender then would remit those funds to you as the borrower since those have been paid. So that's a nice fix. What is permitted under the new rules here, and I'm just understanding this from late night reading. You can actually go back now and reapply for an increased loan amount from your first draw loan. So these are loans that you've already applied for that you have not sought forgiveness for. Employers can request an increase in that first draw loan amount or reapply if one of these things has occurred. So if your partnership did not include the partner compensation as permitted, then you can go back and apply for an increase. I think that has happened a lot. If you remember in the early days of this, there was a lot of confusion. How does a partnership apply for this funding? Does the partner just apply for their employees, but then file separately as a self-employed individual? So if mistakes were made in that process, those partnerships can go back and apply for an increase in that first draw loan amount. Seasonal employers have some greater flexibility under the Economic Aid Act that was just passed. So if that permits a higher lending amount on the first draw loans, then you can go back and request an increase as well. If you are a seasonal employer, my slideshow doesn't get into these details, but the Act does provide a lot of additional guidance on exactly how do you define who a seasonal employer is. So if that pertains to you, you'll want to go back and analyze that information. And then also, if you had returned a portion of your first draw or even all of the first draw, you can go back and reapply for that and garner an increase. I think I should pause there as well. So that is allowing for an increase in your first draw loan amount. I think we need to clarify also that if you never did apply for a first draw loan, that is still available. The funds that were allocated under the Economic Aid Act apply for first-time borrowers as well as the second draw borrowers. So we're going to be going through some more details on what the terms and eligibility are under the second draw lending program. But if you have not taken your first PPP loan, you're still eligible for the same amounts as if you had originally applied under the old rules. And we'll clarify that a little bit as we go forward here. Another great fix that is in here is a tax treatment. I think that, in my opinion, it was pretty clear in the original act what Congress had intended, that the PPP loan was not supposed to be taxable income, and it was not supposed to affect how the expenses were being treated. IRS had a different interpretation of that. Congress has made clear that not only does the taxable income, not only does the forgiveness amount not get included as taxable income, but in addition to that, they confirm that the qualified expenses that result from the forgiveness of the PPP loan are deductible expenses. So that is a great clarification, and happy to see that. So let's get into the second draw loans. Who are eligible now? As you may recall, there were requirements before requiring that eligibility was 500 employees or less. That has now been reduced for second draw loan requests to entities that have 300 employees or less. Also, you can only take a second draw loan if you had received a first draw PPP loan, and that PPP loan must have been used or will be used. All the funds would be used prior to the disbursement of this second draw request. That would include any increase that you go back and request for the first draw. You also had to have a reduction of 25% or more in gross receipts in any quarter of 2020 compared to the same quarter in 2019. Gross quarterly receipts is being defined according to the IRS code. I think I embedded that here in the slide. You can take a look. SBA also has a very similar definition within their existing rules. So that's where you can look. For the most part, gross means gross. I mean, it's all income received into the business. It does exclude any forgiveness of the PPP loan that was received in the prior year. Please note that this is not necessarily annual. This is on a quarterly basis. We'll talk in a few minutes about how you can prove that out. But if you know, you can take the selection if you want to compare third quarter 2020 to third quarter 2019. That's up to you. You can choose which quarter, but you would have to show that one of those quarters had a 25% reduction in gross receipts. Also, from an eligibility standpoint, there were some entities that were left out of the first round, and those entities are now included. So that's a 501c3 organization. That's basically chambers of commerce. Housing cooperatives are now included. Some FCC license holders of newspapers, media outlets are included, as well as what are termed destination marketing organizations. I wasn't familiar with that term. I'm pretty sure I see Jack Cohn on here. I'm pretty sure Jack would know what that was. And that's your tourist bureaus, your visitor bureaus. So those are important to know. If you are a member of those organizations, you may want to inform them that they are now eligible to participate in the PPP lending. Business entities with multiple locations. Certainly this, I would imagine, is an important question for a lot of people on this call. There is some specific guidance placed within the new second draw language regarding business entities with NACES codes beginning with 72. That's your restaurants and hotels. Each restaurant location owned by a parent business is eligible for separate loans if they are a separate legal entity and employ less than 300 employees, and they meet the revenue reduction requirements. So certainly important to note that this is for restaurants and hotels, can be handed out based upon your multiple locations if you have separate legal entities. Same affiliation rules apply that were under the first draw loans. A few minor changes there for news organizations and religious affiliations. Probably don't need to get into that on this call. And then there's some other exclusions from second draw loans. Again, probably don't need to worry about that on this call. It's dealing with a lot of public traded companies. If any restaurants are on here that are owned by the president or vice president, members of Congress, you may have some issues to take a look at there. China-related ownership, and then certainly if your business is permanently closed, you would not be able to partake in the second draw. So what are the terms for the second draw loan? Very similar to the first draw loan. So this is 100% SBA guarantee, subject to forgiveness. Forgiveness can be obtained on both the principal as well as the interest. No collateral, no personal guarantees. Interest rate is 1%. Again, that interest rate is paid by the SBA, assuming you're able and eligible for the forgiveness of the principal amount. It's a 5-year maturity. The last day to apply for these funds will be March 31st, 2021. That holds true for the second draw requests, as well as any increase or first-time draw requests that are being made. So the funding at this point is set to expire on March 31st of this new year. What is different this time around, I think the maximum loan amount last time was a $10 million limitation. The maximum loan amount now is taken down to $2 million. And then a nice change here, the covered period for spending your funds is an 8-week period through a 24-week period, starting from the date of disbursement. And this is now at the bar's discretion. So you don't have to go off of 8 weeks. You don't have to go off 24 weeks. If you want your covered period to be 13 weeks, then you're able to make it be a 13-week time period. That certainly provides a lot of flexibility as you think about retention of employees, and maybe in the future needing to lay employees off. Having that flexibility allows the business owner to be able to structure those decisions to what is correct and right within their own business environment. So that's certainly a nice change to see. Again, for forgiveness of the second draw, you will have the 10-month time period to seek forgiveness after the end of your covered period. So if you take the full 24 weeks after loan disbursement, you still have another 10 months to seek loan forgiveness after that time period. Continuing in the second draw request, loan amount, similar to last time, is 2.5 times the borrower's average monthly payroll costs. I was not planning on going into how that calculation occurs. It's very similar to how it was calculated the first time around, but a nice provision here for all those on this call. If you have an ACES code beginning with 72, again, that's restaurants and hotels, then your maximum loan amount is now 3.5 times the monthly average payroll cost. So a nice benefit to all those on the call here today. You still are subject to the maximum $2 million loan amount for the second draw. If you are part of a corporate group, then there's a single corporate maximum dollar amount of $4 million. Time period for calculating your payroll costs. This is a little bit different. I think it was a little complicated in the first round. They've really tried to simplify it this time. So your time period for calculating your payroll costs is a 12-month period prior to when the loan is made, or you can simplify it and just call it calendar year 2020 or calendar year 2019. So it's at your option for the second draw request, whether you use your payroll costs from 2019 or from 2020, or technically you can do a 12-month time period. So, if you get into March and wanted to use, I guess, February through February, you could do something of that sort. But you do have the option of calendar year 2020 or 2019. We're going to come back to that concept here in just a minute as we talk about how you're applying for your loan. So the application process is still underway. They have named the form. It's going to be the SBA form 2439-SD. SD stands for second draw. It's not available yet, but is expected to be released shortly. From a banker standpoint, we expect that it's going to follow kind of the same process we did before. However, here's a nice benefit in what year you select for your payroll costs. No additional documentation would be needed to be submitted to the for your second draw request to substantiate your payroll costs if you're using the same lender that you used before and you're using calendar year 2019 to calculate both the first draw and the second draw request. In other words, if you aren't changing your calculation from what you gave to the bank the first time, you don't have to prove out that dollar amount this time. So remember, last slide we said you can use payroll costs from 2020 or 2019. I'm going to guess that for the most part, people are going to want to continue to use 2019. I think for the most part, people paid people less in 2020 due to hours worked than they did in 2019. So I think there's a big benefit here. This should streamline the application process. If you're just using the same calculation as before, you would not have to prove out that dollar amount to the lender that you had utilized before. For loans greater than 150,000, you will have to submit the proof of revenue reduction that we talked about. Again, that's 25% for any quarter from 2020 compared to the same quarter of 2019. For loans that are 150,000 or less, you do have to provide proof of the revenue reduction, but that does not have to be at the time of application for the second draw. If you don't submit it at the time of application for the draw, then you will have to submit that to the bank when you submit the application for your forgiveness. So you have an option there. You can make it a little bit easier applying for the funds up front by not showing the proof of the revenue reduction. But if you don't supply that up front, then on the back end, you'll have to supply that proof. Again, as was the case in the first round, you'll be asked to certify in good faith that, due to the uncertain economic time period, to the conditions that we're under, that this loan is necessary. I think everybody remembers, the turmoil that came about from last time. There were entities that had, hundreds of millions of dollars in endowment funds and things that sort that were applying. So this rule still applies. Do remember that the safe harbor still remains. Borrowers under $2 million will be deemed to have made this certification in good faith. The guidance is a little unclear. I think that $2 million is probably on the aggregate level, including both first draw and second draw loans. A little unclear. My guess is that that'll be clarified as time goes on. But you do have that safe harbor. I think the other thing to keep in mind from this good faith certification is that with the second draw, you have to prove that you had the revenue reduction. I think by proving the revenue reduction, it's really showing that there is a good faith certification there that you have gone through some hard times. So there are new eligible expenses that your funds can be utilized for. As you might recall, in the first round, you had the 60-40 split. 60% had to be paid for or utilized for payroll costs. 40% could be used for other things like interest on loans. All of that requirement is still there. So you still have the 60-40 split. But you now have some additional eligible expenses that 40% can be utilized. I'm sorry, I clicked and I didn't mean to click there. Let me hit to go back. Sorry about that. We should clarify that these new eligible expenses are eligible for your first draw and your second draw loans. So this is carried back. You might remember I mentioned there's two pieces of guidance out there. This language is included in the first guidance, so the 82-page document. So that means that these are eligible for your first draw loans. So in addition to everything you could use the funds for beforehand, you now can use them for operation expenditures. Operation expenditures really is it appears defined as business software or cloud computing software that facilitates your business operations, whether that's product and service delivery, human resource processing, sales and billing functions, any accounting software you have. All of those software and cloud computing expenses that you incur now are eligible expenses. Also, and I gotta say, it kind of saddens me that this has to be included, but we know that there was a lot of vandalism and looting last year. Hopefully that has diminished and won't be recurring. But if you did sustain some damage losses due to that vandalism and looting this past year that was not insured, then that is eligible to be used with these funds as well. Another big key here is supplier costs. Any expenditures to a supplier for goods are now eligible to be utilized here. A couple caveats here: it has to be goods that are essential to operations, and those goods had to be made pursuant to a contract or some type of purchase order that was in effect anytime before your covered period began. or if they're perishable goods, which again, I'm guessing most people here are dealing with perishable goods, then it's in effect before or any time during your covered time period. So all of your supplier costs should be able to be eligible expenses, subject to the 60-40 split again. The last new expenditure here is any worker protection expenditures. This is all the PPP stuff that has been added, masks, sanitizers, things that sort, but it also includes any capital expenditures. So if you added a drive-through window to accommodate customers, if you had to add plexiglass shields in working environments, if you had to in restaurants, go around and space out your restaurant different, build walls, separation devices. I think that this would even include if you've added on to your restaurant to include outdoor seating as a result of any of the health requirements. Those expenditures now can be qualified as eligible expenses for these funds. Again, just to reiterate, even with these new eligible expenses, you are subject to the 60-40 split with payroll costs. So I think that is all the slides I had regarding to the changes for PPP funding. Before we get to questions, and I am assuming those are coming in here, I think Hope's going to help us through that. I did want to cover some non-PPP items here. I said before, I don't really consider myself an expert on the PPP lending, but the non-PPP stuff, I'm certainly not an expert for. But there's a lot of good things here. I thought it'd be important to just highlight these. Probably can't answer too many questions for you on how these affect your business, but I do encourage you to reach out, engage a tax accountant. There's a lot of important provisions here. First one is the employee retention credit. I think this is something that for the most part people kind of ignored from the first act, from the CARES Act. There were some clauses that basically said that if you took the PPP loan, most of the time you would not be eligible for the employee retention credit. That language has been revised drastically. You still can't double dip. But you are eligible for the employee retention credit for amounts that were paid to employees that were not utilized under the PPP. Certainly, for PPP, you had 2.5 months worth of payments. That leaves a lot of other funding that went to employees that is eligible for this credit amount. There are large amounts associated with this. I just saw this morning a calculation. I think that for 2020, and this credit goes for 2020 as well as 2021. I believe the provision said that for 2021, it can affect for 2 quarters, and I think it's up to a $7,000 per employee per quarter credit. So you're looking at $14,000 per employee credit for 2020 that you could be eligible for here. So this, above any other point, certainly make sure you engage a competent tax accountant that understands this provision. I think there's a lot of money there that can help everybody out. So please make sure you look into those provisions. SBA is continuing to provide some debt relief to the hardest hit industry, specifically restaurants and hospitality industry is included in that. So if you did have a prior SBA loan through the 504 or 7A program, you want to take a look if you're eligible for that debt relief to have your principal and interest payments made for you for the coming quarters. Idle application process. I know it was a little bit difficult through the first round. Took a lot of time to get through their application process. That has been streamlined. I've been told that there are specific time periods that those idle requests have to be processed in. The grant portion of that is available once again. So you'll want to take a fresh look at the idle process through an SBA program. Also, specifically for the restaurant business here, Previously, businesses could not have 100% deductibility on business meal expenses. Through this new act, for the next 2 years, there's 100% deductibility for business meals. So certainly will help businesses be more encouraged to get out and utilize the services that everybody on this call is offering. So again, I'm not the expert here. Find an expert to walk you through these, especially the employee retention credit. There's a lot of savings there that you can take advantage of. With that said, I think I'm going to be quiet and let Hope join back in here and see what questions we may have here at this time.
Sorry, Clem. Hope gave it to me, so I'll be asking all our questions today. We do have a few, and I have a few extras, like I said. I do have a question that I think somebody asked, but I'm going to try and expand it a little bit. If somebody received an EIDL loan, let's say a tourism promotion agency from the first round because they were not eligible for the PPP, can that remain unused EIDL or what hasn't been used, or can those funds be wrapped into a new drawdown of the PPP? So could the PPP essentially forgive an EIDL loan?
That's a great question. And I want to say yes. To be honest, anytime I read about EIDL, I typically kind of ignored it because the bank itself didn't handle EIDL loans. So as I was reading through the documentation last night, I didn't pay close attention, but I do recall reading something like that. So Melissa, if you can, find out for sure who asked that question, we certainly can follow up on that. So
yep, we can. I think
Jack's raising his hand, so I think it might have been Jack.
And I think the answer is yes too, Clem. So we're on the same page. The 8 to 24 week usage period, is there a date that has to end by when you draw down the loan? So is there kind of, for example, like for the first round, it was December 31st of 2020. Is there a drop dead date for the 8 to 24 week usage period?
So that time period starts on the day that you take your draw. So when you apply for the loan, the bank, I believe, if I recall correctly, we had, I want to say it was 10 days from getting approval from SBA to disperse the funds. So once those funds are dispersed, and it's a one-time draw again on the second draw loans, once those funds are dispersed, that starts your covered time period. Once 8 weeks have passed by, if you used all the funds, you can apply for forgiveness or any time beyond that. So the time period really starts at the point that you draw down on that loan.
Okay, and then just to give you a breather, Clem, we did just get an update that the PPP program will officially open January 11th, but it will only be accepting what it's calling first draw loans from small businesses that have yet to receive a PPP loan. And it will only be accepting those applications from lenders that is signaled as community financial institutions. Then on January 13th, small businesses applying for a second PPP loan will be able to do so. Once again, only with community financial institutions. And then it will open up to everybody else shortly thereafter. So you gotta love bureaucratic speak.
Yeah, actually that announcement just came out about half an hour before we got started. So yeah, just to reiterate that, if you are going back into the first draw, you have not received a first draw loan, or you're looking for an increase, it appears that you can start that on Monday. But the second draw, which most of us are talking about here today, won't start until at least Wednesday, January 13th. The act actually has certain dollar amounts set aside for underserved populations. So I wasn't going to get into the specific dollar amounts there, but there's 15 billion for underserved communities. There's specific amounts to be lent out by what's being termed community financial institutions. We still don't know what that definition is. It may be $1 billion in asset size or less, might be 1.5, might be 10 billion. Nobody has defined that term for us yet, but it does look like Wednesday will be the start of the program, with a lot of other people joining in probably the following week.
Next question I can take, because it's an EIDL. I applied for an EIDL grant, received an application number, but never received the 10K. What can I do to get that 10K, if anything? Susan, we'll look into that, because that is an SBA disbursement. So we can look into that. It depends on when you applied. I do know that those funds ran out, but PRLA can look into that. If you received the first PPP and are now applying for forgiveness, if you apply for a second PPP, will that also be forgiven with proper paperwork? Well, it should be, but let me go back. This is a good question, Clem. Do people need to be forgiven for the first PPP before they can apply for the second?
No, you do not. You do have to make sure that you have utilized all the funds from your first loan before applying for the second loan, but it does not have to be forgiven. You still have your 10-month time period from the end of your first covered period to seek forgiveness on your first loan. So that there are really probably two separate forgiveness processes.
And to reiterate, kind of for those of you, because I know some of you are doing a first draw, PPP, whether it's first or second draw, is completely forgivable if you use it properly, if you do the 60-40 split the way you need to. So no matter what, that is forgivable. Now, if you got an EIDL loan, that is a loan, so that is not forgivable. So that's really the difference between the two, which is why for a lot of our 501Cs on this call, this PPP is really important, because you all applied for an EIDL, but now you have an opportunity to get a forgivable loan.
That's correct.
Okay, this was one I had on my list, Duke, so I'm glad you're on. Their business was not open first or second quarter in 2019, but was open all of 2020. I read the just release guidance, but the example they gave for eligibility is unclear. Can we use either quarter in 2019 compared to any quarter in 2020? So I guess the question is if they weren't open in 2019, in the first part of 2019, could they do first quarter of 2020 compared to third quarter of 2019, or does it have to be matching quarters?
Yeah, it has to be matching quarters, which if you think about that makes sense. I mean, they want to take out the seasonality effect that you may have. So it does have to be matching quarters.
If they weren't open in 2019, could they use the beginning of 2020 compared to 21, or the last of, is there any way that somebody who wasn't open in 2019 to be eligible for a second draw of PPP?
So there is some provisions in the new guidance regarding that. Why don't we get back to them on that, Melissa? I just want to clarify my understanding there before we do that, but there is some additional guidance there.
Okay, thank you.
You know what, that made me think of something a little bit unrelated, but thinking of this quarterly time period, what the guidance is permitted is that when you're proving out your gross revenue reduction, we're talking about quarter to quarter comparison. A lot of entities might be very small and they don't have quarterly analysis, and a lot of entities might just have some type of annual financial reporting through a tax return or something like that. So the guidance does allow you to look at it on an annualized basis. So on an annualized basis, if 2020 annual income is 25% less than 2019, you don't have to go in on a quarterly basis and prove that out. You can compare on an annual basis, which makes sense. If you have an annual drop of 25%, then mathematically that means at least one of your quarters had to have that 25% drop. But for those that don't do quarterly reporting, you don't have to worry about it. You can still use your annual reporting, and that reporting can utilize internal financial statements, bank statements, It doesn't necessarily have to be tax returns. In fact, a lot of people won't have tax returns filed before the end of this funding period.
Okay, we got a couple in the weeds questions, so you can chip back to us and we can look into it too. I understand gross income doesn't exclude the P3, but does it also exclude idle loan amounts for gross income?
So the idle loan is a loan. It's not revenue income. So that really wouldn't be included in revenue anyways. If you're talking about the grant forgiveness part of idle, that would be excluded as well.
Okay. Can gift card sales be excluded from gross sales? We normally show gift cards as sales at the time of redemption, not at the time they are sold to the person gifting the gift card.
That is certainly more in the weeds than I know.
I warned you about Mick Owens at the beginning of the call, so I apologize.
So, yeah, we'd have to go back and take a look at how the IRS defines gross receipts there.
We can probably go back to the National Restaurant Association as well. That's probably a question they're getting to, so we can probably give you a pass on that one.
Good.
You did answer the next question. You do not need
hey,
your
Melissa, just to go back to give you the lender's perspective. If somebody internally here asked me that question, I think my off the cuff answer would be it's how they report the income. So if they're reporting gross receipts, on their tax return according to the IRS, then that's how it would be recognized.
And I'll reiterate this answer again. You do not need to have your first loan forgiven to draw on the second loan, but you do have to use all of the funds from the first loan. Do you have to set the covered period at the time of the loan, or can it be when you go to get it forgiven? So do you have to, when you draw down the loan, say I'm going to use it in 10 weeks or 12 weeks when you draw it down, or can you decide as you move forward with it?
No, you can decide as you move forward. So that's something that's not disclosed. You can decide when you cut that covered time period off. But again, that question made me think of some interaction here. Again, you really need to engage your accountant in some of these conversations. Think about the interplay here now between the PPP funding and the employee retention credit. I said, you now are eligible for both, but you can't double dip. You can't say, okay, well, I use PPP funding for wages that were paid in May, but I'm also going to claim those May wages as part of the credit. You're going to want to plan this out because you want to make sure that you can maximize your credit as well as PPP. So, in the past, we told people that, yeah, you have this 60-40 split, but since you had 24 weeks that you can use it, really, you can just say you used all of the PPP funding for your 2.5 months payroll cost, and everybody's at 100% usage, and you didn't have to worry about that 60-40 split. Now you may want to do that calculation and assign the 60-40 split, because the more that you use, I'm trying to think the best way to say this, the more that you use your PPP funding for that 40% of allowable expenses, that likely permits you to take more tax credit from the employee retention credit. So there's a lot of interplay there. You got to really decide how you're going to apply for the PPP forgiveness, what you're assigning to the payroll costs versus the eligible expenses.
Okay. I can answer this one. You can do 3.5 times 2019 payroll costs. That's correct. And as Clem said, you can also use your application for the first round for your second round, as long as you're sticking with the same payroll from 2019. See, it's sinking in for me, Clem. You did a good job.
There was, I didn't put this on the slide, there was one clarification on how you calculate payroll costs. There was disagreement or misunderstanding, I think, originally on what was included in total payroll costs. And I believe now, I was looking for my notes and I lost it. I think that there was disagreement on whether you could include insurance costs for dental and vision and some of those other benefits. Those are now specifically included as eligible payroll costs. So that's something that you want to think about as how you calculated your 2019 payroll costs initially.
This is for one of our larger restaurant groups. How do they define a single corporate entity, a single corporate group in order to borrow the $4 million?
So it really goes back to the SBA affiliation rules. Those can get fairly complicated. So I think, we could give you some pointers, but it's best probably sitting down with your accountant and making sure that you understand how your affiliation fits within your unique business model.
Okay. For this one, people who did not apply for the first round of PPP cannot apply for this round. That is incorrect. If you didn't apply for the first round, you can apply for this one. This is for anybody who wasn't eligible for the first round, or maybe I would yell at anybody who didn't apply for the first round and could have, but anyone can apply as long as you meet the new as long as you meet the definitions. Regarding, yep, go ahead.
So I think when I read this first yesterday afternoon, I thought the same thing. So the reason that idea is out there is that, remember, I mentioned at the beginning, there's two different guidances that were put out here. And if you read the second guidance, which deals with second draw loans, it states that you had to apply for a first draw. But if you go back to the first guidance, it says that you're still eligible to make that first draw loan. So it's good clarification. And to your point, Melissa, I do know of some business owners that said, first time around, we have enough money set aside. We're going to make this through without seeking government help. So I do know that there are some people out there that, despite advice that I even gave them, they chose to tough it out. But, now that this has lingered on, likely would reconsider that.
And then regarding the first PP, with a simple one-page forgiveness application, with a one-page application be able to be used if we had a draw of 109,000, so less than 150.
Yes.
Yes. All right, let's see. This is a question for me. Do you see any movement towards forgiveness for idle loans under 150,000? No. I think if you can wrap it into the PPP, that is how you would be able to get an idle loan forgiven. But I don't see Congress, they'd have to pass another piece of legislation for that one, Crystal. This is another one that I know the answer to if you don't, Clem. The first draw had a restriction approved in August 2020 regarding paying rent to related parties. Is that still the same for the second draw? And that answer is still yes. That restriction was not addressed. Maybe in the next bill, but that was not addressed in this bill. Okay, regarding forgiveness, if my wife is now assisting with running our restaurant during this time, does her pay ultimately become unforgiven?
Does her pay become unforgiven?
Because I guess he's the owner, so she's married to the person owning.
So if my understanding is that if your spouse is, legitimately working in the business, they're an employee, they are receiving, wages, then those would still be eligible wages that are an eligible payroll cost. Is that what the question is?
Yeah, and I think that we've ran into some that they warn against. If you didn't, you need to prove that you're not paying your family just to use up the loan. So you can't, hire your kids to wash dishes in the back just so you can say that that's a forgivable expense. I think that's but if they're regularly or have been on your payroll before this came through, I think that would be fine.
Correct.
Businesses that did not have employees, are they still able to apply for things like rent and back rent owned?
So you still have the limitation of 60% has to be for payroll costs. Now, when you say did not have employees, there's still an owner running the business. So the owner could apply. There's, this goes back to the first round of loans. There's, very specific instructions on if it's a sole proprietorship, how you calculate your quote unquote payroll cost. It really is the net income of the business that would be eligible up to the $100,000 per employee amount. So that would still be eligible to them.
Okay. And then just for everybody on this call, we're gonna give Clem, a break at noon. So those questions that we don't get answered, we will circle back with all of you, because I still have like 37 messages that we have to get through. So we'll get through what we can till noon, and then we will get back to everybody else. Please clarify supplier costs that are eligible, orders in effect at any time before the covered period. So paper supplies ordered prior to but delivered during the covered period would be applicable. Also, our perishables purchased prior and during the covered period would be applicable, but not all goods, just perishables. I guess they're looking for more information on what is supplier costs, and that might be something we need to dig into a little bit more.
Yeah, and there really wasn't any definition given on what is perishable versus non-perishable. So my guess is there'll be some more guidance out there, I think. But I think that the way that question was stated is my understanding. So if you're purchasing napkins, as long as that was subject to a contract before your covered time period, even if they're delivered after your covered period, that payment is being made in the covered time period and would be an eligible cost. But if it's food being delivered, that can be ordered and delivered during your covered time period.
Okay. I have some idle questions that we'll get there. There's not another idle advance associated with this round of PPP. I think there were some idle loans, but we'll get back to all of you on the idle questions. Let's see. Question for the 150K to be streamlined, is that for each loan or combination of the two loans?
That should be per loan. So if you had multiple entities that had loans, it's on the forgiveness application is on a per loan basis. Maybe you're implying the first draw and second draw loan. So that would be separate loans as well.
And then is there a priority given to certain businesses? I thought I heard something about businesses with a loss of revenue of 75% getting first priority.
There are different priorities. I don't recall that it was based upon
revenue loss
amount. So I think it was based upon underserved communities and things of that sort.
And as we just mentioned, when the applications open up next week, first draws do get first crack at it before second draws. So there will be priority for that next week. Let's see. We're getting a lot of questions. I'm going to skip through some of the idle ones because that's just not, and we'll get back to them individually. How quickly might the funds run out? That's the billion trillion dollar question.
So if you remember the first time around, there was I think 349 billion set aside. Those ran out pretty quickly. Congress came back, set aside another 310 billion. All of those funds did not get utilized. I think there was still, I don't know, 115, 120 billion that was not utilized. So I think that Congress has stated that in this case, they believe that the new allocation of 284 billion, they believe is sufficient, but if not, they would quickly come back. I think, I can't remember if it was Hope or Melissa referred to this act as, the down payment. I think that was President-elect Biden's terms. So, certainly you want to act quickly, try to be first in line. But if for some reason things get delayed for you, I would anticipate that Congress would act quickly and fund more as needed.
Okay, I have one I'm going to do one more question because there are a lot of questions in here that were answered over the course of the webinar. But I know we talked about how PPP and EIDL were not part of gross income. If somebody received a county CARES grant from the counties, does that count towards gross income?
I would be guessing at the answer. My guess is the answer is going to be no, but I can't tell you that for certain.
Yep. Okay. Yes, it's 3.5 times. And like I said, this webinar has been recorded. So, and we are coming up, we're getting a lot of repeat questions. So I think we're going to wrap it, and then Hope, if you could pull out the ones that we still need answered and send them to me, I'll take a crack at them. And we are right at 12. And so we will wrap this up. Clem, thank you so much. Clearly we have a lot of questions, and I think this really paved the way. It looks like the applications will be open next week. So we will probably from this put together an FAQ and get answers. But a lot of your questions have been answered over the course of the webinar. So please go back through it and see if it was. And if not, you all have my email and Hope's email if you have any additional questions. And like I said, Clem, Aaron, thank you so much for taking the time to do this. This is really top priority for our members to get through the coming months. And this was extremely helpful.
Sure. Glad we could help out.
All right, everyone, stay safe and we will talk soon. Thanks.
Thank you. Thanks, everybody.